I will begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Kara Glashing, a Virginia SBDC business advisor. She will introduce herself and take us through a presentation on understanding your financial statements. Please feel free to ask questions using the Q&A function. We will respond to them as we go along. For questions that we don't get to today, please shoot us an email and we will be happy to address them through our no-cost one-on-one services or connect you to resources that can help you. I will share a recording of this webinar and the slides as part of a follow-up email. So what is the Capital Pathways Program? It is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then go through the program eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Being capital ready matters because businesses that are less prepared can self-select out of or fail loan applications. Early failures correlate to a lack of adequate capital. Higher cost alternatives don't build long-term capacity. Ultimately, only half of the loan amounts requested reach small businesses. And to put things into perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive hands-on group experience paired with one-on-one support. Who is eligible? Very small businesses and nonprofits at any stage who face challenges assessing traditional financing. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit business advising. Sorry, there we go. We start with an assessment, a self-assessment that pinpoints your business key gaps so we can connect you with tailored resources, either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we partner with a law firm, which can help with more complex topics related to business registration, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics such as financial basics like this one, as well as financial statement preparation and QuickBooks training. Our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, loan readiness, and lender prep. Our loan application readiness services include both webinars and one-on-one individualized support. These webinars cover topics such as what lenders look for in loan applications, interactive mock loan interviews, SBA loan options, and sample application analysis. We also have a partnership with a lender that provides one-on-one support to those looking for capital. Finally, our credit building advisor will help you review and interpret your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for better financing options and terms. If you're interested in getting started, you can reach out through our website at virginiasbdc.org/programs/capital-pathways, or you can reach out to us directly at capitalpathways@virginiasbdc.org. And I'll share that email and the website link in the chat for all of you to have. Now, on to introductions. As I mentioned before, my name is Sheila Lamb, and I am today's moderator. I serve as the customer support specialist for the Virginia Small Business Development Center, which offers the Capital Pathways program. Today's session will consist of a 90-minute presentation. Feel free to ask any questions throughout the presentation via the Q&A function. We will be responding to them at intervals throughout the session. Any questions that we can't respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording of this webinar and the slides in a follow-up email. Now I will pass things over to Kara Glasheen to introduce herself, tell us a bit about her background, and start the presentation.
All right. Thank you very much, Sheila. I'll be sharing my screen in just a moment. I have a request set. So it's great to be here with you all today. Thank you so much for turning out. I'm always surprised people are excited to get into financial statements. It's a topic that, as an SBDC advisor, I wish I had more time to cover in my one-on-one advising sessions. So this way, you can share this recording with folks in advance, answer questions real time, and hope everyone attending can walk away with a better understanding of some of these key financial statements that come up a lot in conversations around lending and just general business planning. So if you should be able to see my screen. I want to welcome everyone here, whether you've been running your business for years or you're just getting started. If your financial statements have ever felt difficult or like a foreign language, you're in the right place. This is a part of operating a business that is not taught in most places. So hopefully today we can bring some clarity to the overall topic. Now, I am to help guide this presentation. I've brought together a example of a business owner. We're going to call him Craig, and he is a Virginia Beach landscape company owner. And so hopefully a lot of you in attendance today find some things in common with Craig. You would say he's a solid business owner. He's a solopreneur, meaning he owns this business on his own. It's an LLC. He's not taking a salary. He occasionally hires some contractors to help with work, but he doesn't have payroll just yet. And he uses QuickBooks for invoicing, basic expense tracking. He has a bookkeeper that helps him stay organized, but he doesn't do a whole lot with financial statements, maybe files them away. And when questions are asked about ratios or specific financial metrics, he doesn't have the numbers on the top of his head. And frankly, he might not even know if his reports are accurate. So as a busy business owner, it can be difficult to take action and learn how to take control over your financial statements. But today's goal is to help Craig and you here become more confident and more confident users of your financial data. So to start this off, also, I wanted to make this available at the beginning. I have a QR code and a link here, which I should be able to put in the chat if you bear with me. This is an example. Let's see. I'm not sure if I can. I'm pasting this to Sheila. If you could share this with the attendees. This is a link to a Google Sheet document with a full financial statements that I'll be screenshotting and referencing throughout this presentation. If you are a learner that likes to get your hands on the materials as we're looking through, I welcome you to open them up and follow along. Otherwise, it can be a resource for you to review later. All right, back to it. So today's learning objectives first is about understanding what each statement shows, to look at these statements so you can spot some trends and red flags and potentially detect errors, to use your financial statements to plan, pivot, or even seek funding, and also to be able to check the health of your business in just hopefully a few minutes. Now, we're going to go through this one financial statement at a time, and then we're going to talk about how all three of them connect. To get the most from today, as a business owner, it's helpful if you are already using an accounting software and you trust that your numbers are at least somewhat accurate. If you're not there yet, that's okay. This is a good step to aim towards, and getting those current clean books is going to be step number one to be able to utilize what we talk about today. And also, this is focusing on for-profit businesses. Nonprofits use slightly different terms and formats, but a lot of the concepts will still apply. And this is a boot camp. We're going to go through a lot of material pretty fast, but Sheila did share she'd be sharing out these slides and a recording. So I welcome you to replay, go back, revisit topics that maybe don't stick on first go around. So our financial statements. There's actually a lot of reports your accounting software can spit out. There's aging reports, budget versus actual, plenty more. But for today, we're focusing on three, and these three matter more than most. They're what every lender, every accountant, and investor would ask for. And with each of these, they answer different questions about your business, and no single one of these statements on their own gives you the whole business. So I want you to think about it like your car dashboard. Your speedometer, it tells you how fast you're going. That's going to be your income statement. It tells you how much you're earning is through the operations of your business. Your fuel gauge tells you whether you'll make it to your destination. That's your cash flow statement, telling you whether you have enough cash. And your temperature gauge tells you whether everything's healthy under the hood, and that's going to be your balance sheet, which shows your general financial stability as a business. So we need all three to make the best decisions possible. We wouldn't take a major road trip watching only one gauge, although you can run to the store real quick without worrying about it when the stakes are low. But if we're planning on a big trip, you want to make sure that you're looking at all three. So that is what we're looking at today. Before we get started, I do want to address some accounting definition. This is the concept of cash versus accrual basis accounting. And Craig, like I expect a lot of you might use a hybrid approach. So accrual basis accounting means that you are recording revenue and expenses based on when they are earned or owed, not necessarily when the cash is received or paid. So if you have contracts for your business, for example, and maybe the contract is 6 months, you might receive the cash at the beginning or at the end. Accrual basis is going to be figuring out a way to recognize that based off of when the service is happening, versus cash is when it hits your bank account. I bring this up because it does have an impact on your statements and the sort of accounts you'll see available on your balance sheet. And so today we are using this hybrid approach for someone like Craig, who mostly runs his business on cash basis, but does use invoicing through QuickBooks, which is more of an accrual technique, and we'll explain that as we go along. All right, so this is the first major section. We're going to be going into our income statement. So the income statement is really your performance report card, also known as your profit and loss. These two terms are interchangeable. And what it shows is your business performance specifically over a period of time, like a report card. So we're looking at all of 2025, or we're looking at January to June. And this is a movie of your business performance, not a one point in time. So the basic formula that goes into any income statement or profit and loss is it's your earned revenues, subtracting out your expenses, and bringing you to your net income. So what does this look like? On the right side of the screen, you'll see an example. So this is Craig's income statement or profit and loss for the period of January to June 2026. At the top, we're starting with the income. Sometimes we call this revenue. And this is all of the customer payments and less discounts and returns. So cash in, there are some negatives. Potentially, if you're tracking discounts and returns, these could also show up in that income section. Then we move to the cost of goods sold section, sometimes cost of sales. Some businesses don't have cost of goods sold. For example, if you're a consultant, maybe you're just selling your services by the hour, not tracking any unit-based expenses. These are things that should be variable with your sales. And when you're selling products, this is really clear, but it can apply.
Kara, you're frozen on my screen. I'm not sure if others are seeing the same thing. I just wanted to let you know. If others are seeing the same thing, if someone could drop it in the Q&A, that'd be great. Thanks. Daycare is trying to get back on. We apologize for the technical issues. We'll give her a moment and see if she can get back on. I think some of her peers are on this call, and if so, if one of you all could reach out directly to Kara to make sure that she's able to get back on, that would be great. Tachi and Jordan, if either of you all are still on here, it would be helpful if you could maybe give her a text and let us know what's going on. We appreciate it. We'll give her a moment to come back on. There's so much good information. I don't want to have to reschedule. Okay, the internet went down at the office. So the office is trying to get a hold of Kara to see if she can get on another way. If not, we will definitely get this rescheduled for you all. And I see a note. Yeah, we do have the chat disabled. We just have the Q&A function open. Because of the number of attendees, we keep the chat closed. Um, I don't have the document. I'm looking at the Q&A right now, but we can actually get the slides out to you. I think it'll be make more sense if you can see the recording. Um, okay, so the office is working on a solution to get her back on. So if everyone can just hold tight for just a moment, if you have something else you can work on while we give her a chance to get back on, I know she would like to go ahead and get this information out to you all. So, Um, so the Q&R code, I'm not sure. She sent a Google Doc. I'm gonna looking at questions. I can share that again if that is what someone is asking about. If not, we will definitely um, get you all the information that you need. Just drop that. Let's see. Okay, I don't have any updates yet, but I did get an email. Let's see if that's her. All right. So, Jordan, do you have anything new for us? She's running around the office trying to get this fixed. Someone did ask if I can expand on the Capital Pathways program. I will put a plug out to Valeria, if you're still on here, if you could do that. I do not run the program myself. I'm with the Virginia SBDC. But if Valeria is on here and wouldn't mind coming on and maybe talking a little bit about Capital Pathways, I'm not sure if Valeria is still on in our panelist. Um, but we'll try to help as much as we can. You just never know when technology is going to fail us.
Good afternoon, everyone.
Thank you,
Yes.
Valeria.
Um, if you have any questions, I'm here to answer. As Sheila mentioned, um, our Capital Pathways program specializes in helping small business owners with less than 10 employees, also nonprofits, to become capital ready. So we help with through webinars, one-on-one services. We also have other services. We connect with lawyers so you can answer specific questions about contracts. We also help you set up your QuickBooks account or any type of accounting system that you need. Um, but I would love to answer any specific question you have about the program.
And you all can drop those into the Q&A
Yes.
function. Thank you. And I just dropped into the chat from Kara's office. She's very excited to present this to you today. She is hoping to have an answer in the next 3 to 5 minutes about getting back on to continue the presentation. But of course, if we can't, we will definitely make sure we get a rescheduled date soon. I can also check back into our old files for a recording from our previous session and share that as well. It's always good to be able to ask her questions live, but if we can't do that right now. Um, okay, Valeria, we had a question. Are there services you just mentioned free?
Yes. All the services are for free.
Thank you.
One of the things that I think is, like very exciting is the credit to capital program. Right now we have contractor that is called NAF, and with them we have access to a very fancy software where we can review your credit score, not just credit score, personal credit score, but also business credit score. We can give you tips how to improve it, what specific items to look for. So I think that is one of the value propositions about this program.
Thank you, Valeria. Oh, I see Kara coming back up. You're muted.
All right. Are there people still here? Yes.
Yes, everyone is anxious for you to come back.
I
So
am so sorry, everyone.
no
We
worries.
lost Wi-Fi at my office. So I've
All right.
been running around, um, and it
We
just
are
came
just
back
so
on.
happy you're back. So thank you, Kara, for working so hard to get back. There you go. You got your steps in for the day.
All right. Whew.
All
So
right.
apologies. Um,
Thanks.
so we were in the middle of talking through our income statement. Thank you all for hanging on with me. I think that was a good little 10-minute break, but I'm clear to stay on longer. I understand if folks have to leave early. So technical glitches, they happen. We were just talking about it before. So in our income statement, we've gotten through our operating expenses. These are our typical fixed things, part of running the business. In theory, these you would still have to pay even if you didn't make any sales in that month. So our rent, our utilities, marketing, other admin costs. From here, this gets us to the net operating income line. But then below this, we may also see other income and expenses. I like to bring this up. They're not super common, but this is where you'd put money in and out that's not directly related to operations, like credit card rewards, interest earned, things like that. And then we get to our final line, net income, net profit, and this is what the businesses actually earn from the statement. So this is really where we're going. Now on Craig's profit and loss statement, what I'm showing you here is a 6 months summed up profit and loss. So this is January to June. And we can look at this and pull out some pretty meaningful information. These are numbers you'd want to be able to share about your business if requested when you're talking to potential financiers, but also just some key stats to know about your business. So we can see over this period, the Craig's landscaping business generated 94,000 or so in total income. The costs of goods sold associated with providing these services was about 36,000, and his gross profit was 57,600 with a 61% gross margin. Now, the operating expense portion is about 24,000, and that gets us to a net operating income of about 34,000 and a 36% margin, which sounds really strong for the industry. Any business that can brag a 36% net margin is in a pretty good spot. So what this tells Craig is that for every dollar of revenue, 61% remains after direct costs. His average operating costs are about 4,000 a month. We get that by dividing those total operating expenses by 6. And then we see that he's solidly profitable at 36% operating margin. But looking at the full 6 month smooths out patterns where if we just look at 1 month at a time, signals can be misleading. And so this is getting us to the idea of, especially if you're accounting on a cash basis, meaning you're counting a lot of your revenue when the cash hits the bank, and you're counting your costs when you pay the bills for the costs. It can be misleading, like I said, to just look 1 month at a time. For Craig, he's counting his revenue based off of when the invoices are sent. So perhaps that's a little bit before he's performing the service, but for it to be on his income statement, it's not necessarily when the cash is received. And then his costs of goods sold are real time when he pays for the labor and materials. So this is a challenge. Almost all small businesses either use pure cash basis or a mix. And this can create, like I said, those bumpy margins. And when we look at this month by month, those margins look, there's quite a swing. With January, perhaps there's slow winter revenue, but he's still buying materials. And just not as much. It looks like a really strong 75% gross, or sorry, are we still there? Yeah, we've got a 75% gross margins. Actually, I think I think this math might be wrong. This is showing our costs of goods sold as a percentage. No, apologies. This is our gross margin. So it looks really strong because he's keeping 5,900 out of 7,900 in January. And then in February, where he's getting to keep less, so 49 cents for every dollar. And then March, revenue starts to catch up to the materials that he's already purchased, and now we're sort of leveling out closer to the average. So the important takeaway here is that we want to look at the trends and not just focus on 1 month in isolation. For a second here, I want to focus on where I've gotten a lot of questions. There's some confusing terminology around net income, net operating income, net profit, EBITDA, and just list these out here really quickly. So net income and net profit, functionally, these are the same things, different names that can be used somewhat interchangeably. So that would be this number here, this 6,000. Versus your net operating income excludes the other income, other expenses you would see down at the bottom. This is what is important for when you pay taxes going on Schedule C. And then there's EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And then sometimes people talk about EBIT, earnings before interest and taxes. And this is showing the operating performance before financing and equipment costs. So taking out these two numbers up here, the 250 and the 800. And then when we look at this for Craig, we see these numbers, net operating income, net income, EBITDA, these are all slightly different values. They're all pretty close, but they have different uses, and there's different times where you might be asked for one over the other. So a quick aside, how you file your taxes, the entity type has an impact on your income statement. So if you are a small business owner, you likely, and you're a LLC owner, you're likely either a single member LLC or a multi-member LLC. And so your ways you could be filing your taxes is either as a sole proprietorship or as a partnership. This is the most flexible option. This is where your business profit basically shows your personal income. And you're taking owner draws to pay yourself, just transferring money out of the business bank account into your personal bank account. Versus your S Corp, if you make the tax election to be an S corporation, you are basically telling the IRS that you are an employee of your own business and you are taking a reasonable salary, which shows up as an operating expense on your business, which means it's on your profit and loss statement. And then the remaining profits are what passes to your personal tax return. And this way, your salary can reduce your business net income, and you end up paying less taxes on owner distributions than you do on draws. And I know this is complicated. It might take reading back a few times, but to use Craig as an example, Craig is a sole proprietor, as I mentioned, a single LLC owner, and his net income for March in this example was $6,384. And so in theory, this is what he should be paying taxes on, or close to, give or take deductions, other things. But if he were to take an owner draw, so for March, we're saying he's going to take $4,500. This is taking it out of the business account, and we'd see this on our cash flow statement, which we'll get to in a little bit. But if he was an S Corp, he could be taking a reasonable salary, say $3,500 a month, and then he has to pay additional payroll costs, but he still has remaining profit that could pass through the business and be taxed at a lower rate. And so this is a little bit of a dance based off of where you are in your business ownership journey. Working with a CPA is a great step to make sure that you've got this set up properly. I'm happy to address questions as that comes. Now, I also want to share that we're talking through some different rules, some ideas that we can apply when you are looking at your income statement. And so here I want to introduce just a simple expense control rule. And the general theory of it is that what we should be watching over time is your business's gross profit. And your gross profit, again, is how much cash you get to keep after your cost of goods sold. So in this chart, we're seeing sales over time increase, and our gross profit obviously is a little bit lower because it's that cost of goods sold is here. And then at the same time that this is happening, your operating expenses are here in the green. And this blue triangle represents the cash you get to keep, the difference between your operating expenses and your gross profit. And so the point of this is that for a business owner, what we care a lot of times about is the ending profits, what you get to keep at the end, where a lot of business owners focus maybe too much on overall sales, on revenue goals, revenue targets. And the point of this is that as you're watching your gross profit over time, and if you start to get to a point where you see your gross profit is starting to drop, we want to make sure that you're cutting controllable operating expenses at the same time. So if we saw in a prior month, if Craig's looking ahead and he's expecting that his summer gross profit's pretty good right now, around 12,000. A slow December could cut it down to 6,000. If he does nothing, his profit's also going to drop by 6,000. But if he uses the simple expense control rule, He's going to work quickly to cut controllable costs, fuel, equipment rental, advertising, subcontractor hours, whatever he can to reduce those operating expenses. And the result is he ends up recovering more and protecting his profit real time. To be able to do this, you have to have pretty clean books, be involved, be watching for trends, and being able to act in front of it. So that's our goal. And this works because it keeps you profitable during these tough periods. It forces you to make quick decisions on your controllable costs, and it can prevent slow bleed that can really hurt businesses. Another tool I want to share, this is from Cashflow Mike. You can, putting this out there, you can take a screenshot. It is a quick diagnostic tool that you could print out, keep handy. And it points out different patterns that we can look at our income statement to quickly identify where you are on this chart. So for example, Craig's trends from April to June, we see his sales increase by 300, but his gross profits drop by 500, and his operating expenses drop by 100, and his net profit goes down 400. So while it's a good sign that his sales are growing, it's showing that his gross profit is decreasing. And so the call here is that he needs to make sure that he's cutting his operating expenses as he's available and ensure that he's not going to be, getting into a situation where he's at a big loss. And so you can take some time separately to look through these situations. Some of them are more dire, while others are, good positions to be in. And the ideal one is right here in line 3. All right. Now, again, we're a little bit behind, but I'd love to address any questions directly related to the intro or the income statements.
Of course, we had 3 questions come in. First one was early on. For a consulting service type business, which accounting method is a best practice?
And so the cash basis is simplest. I think simple is because cash is what you're going to file your taxes on. Talk to a CPA about making sure that what the numbers you're providing are cash basis. I think that's a mistake some people can make if they're handling taxes on their own. But as it's still in QuickBooks, you can toggle between cash and accrual based accounting. So it's good to know about both, and you can toggle in and out. But probably you will be wanting to send invoices either in advance or after services provided. And so, I don't know, whatever is easiest. I'd say talk to an SBDC advisor to make sure you understand the implications of what's going on.
Thanks, Kara. Next question. Is it wise to select S corp tax if your company's income is variable?
And so variable on its own, it can work, right? As long as you're planning appropriately. For example, if you are a seasonal business, you may want to have a stable income, even if the majority of your work is in the summer, maybe you're planning in the winter. What you would need to do to be able to make that work is to plan accordingly and to have a good idea of the cash you should be able to generate over the course of a year. If you're not at a state, if we're variable and maybe not as high, then there's advantages of staying on that owner draw because you don't want to. And it's harder to take a step back once you make the S corp election. So making sure that your business can afford it, you have the sales to support it, even under variable, is all right.
And the last question we have right now is, how important is EBITDA, or is it
EBITDA.
thank you, or is it just a measure of perspective?
So I wanted to share that because it's a term that bankers or lenders might use. And for a lot of businesses, EBITDA will be the same thing as net income or net profit. Because if you're not paying interest on outstanding loans, and if you're not currently depreciating assets, then they're the same. At this stage, I think the important thing I want you to take away is just that it's a term that people might use, and you shouldn't be scared of it, but you may have to do a little bit of arithmetic to get to the true number.
Great. That's all the questions we have right now. Oh,
Yeah.
wait, one just dropped in. Let's go ahead and take it. If you're an S corp and you have an independent contractor that provides a service to your business, does the independent contractor cost fall under the operating expenses or do they come out of the profit?
So if they fall under the operating expenses, they do come out of the profit. The question I think this might be is if the contractor, assuming they are a true 1099 contractor, meaning you collect their W-9 at the beginning of the year and then you file their 1099s at the end of the tax year, it depends on their function. For example, in Craig's landscaping business, I'm assuming he is hiring 1099 labor support for some of his landscaping jobs. Um, and in that way, these are going in the cost of goods sold because they're directly related to the jobs. Now, if you're hiring a 1099 accountant, for example, this is an operating expense. This isn't tied directly to your sales. So we need to think about what service are they providing? Is it tied directly to revenue? And that tells us the placement. But either way, they would be on that income statement.
Okay. All right. That's it for now.
All right. So now we are moving on to the balance sheet. The balance sheet is your business's financial health snapshot. Now, I first to put this as a visual, the balance sheet is called a balance sheet because it balances. There should be two sides to this. The assets are one side of the balance, and the other side are your liabilities and equity. And your assets are equal to the sum of the liabilities and equity in your company. Now, your assets, these represent the stuff you own. So this is your cash in your account. This is vehicles, equipment, things like that. Your liabilities, that's money you owe. So your debts, loans, credit card balances. And your equity is what you've built. So that's the history of the retained earnings you've built in the business. It's also where you would be able to see historical owner draws and owner investments if organized properly. So this is a specific moment. So when you have a balance sheet, it's always balance sheet as of X date. You can pull a balance sheet as of July 22nd, 2026, but a lot of the times you do see them at like end of months, end of years, etc. Now, again, in plain English, the balance sheet equation, what I want you to remember is what you own is equal to what you owe and what you built. And we'll see this in as an example here. So using that same color coding, we've got our assets, our liabilities, and our equity. This is Craig's balance sheet that's also in the file I provided. And we can see here exactly what we just talked about. The cash he has, the cash he's meant to receive from customers, the stuff he owns, the money he owes, and his owner investment, retained earnings, and owner draws. And what we see is the total assets are equal to the total liabilities and equity. Now, again, I think this is basically what I just explained. Assets, what those include, liabilities, what they include, the equity, what those include. A quick note on terminology, the balance sheet equity section does actually vary by your tax entity. So we use different terminology to mean pretty similar things. For Craig, he's filing as a sole prop. He's not taking salary. And so we see terms like owner investment, owner draws. Instead of if he was an S corp taking distributions, we'd see paid in capital and owner distributions. This is getting into the weeds, into some semantics here. And if you have the wrong language on your balance sheet, a lender will understand, your advisors will understand, but I do like to share in case there's any confusion in those areas. So once you have your balance sheet in hand, produced, there's a few quick checks that I like to recommend that you can use to assess, like, is my balance sheet in good shape? A lot of the times, if you've had some messy or sporadic bookkeeping, your profit and loss statement looks pretty accurate. You don't see anything off, but your balance sheet is where the mistakes kind of roll onto or get hidden. So here's a few things to look out for. On a balance sheet, the first thing to check is what's listed as your total bank accounts. This should match what is actually in your total bank accounts as of that day, as of the date of the balance sheet. You should, when you look at your balance sheet, understand what each account describes. And if there's an account that you don't understand, this is a great opportunity to have a conversation with an advisor. And then you should be suspicious of negative numbers. There are negative numbers on the balance sheet for good reason, but a lot of these accounts are supposed to stay positive. For example, if we have credit cards listed under liabilities and you see negative 500 on credit cards, that would be telling us that you've overpaid your credit cards by 5,000. Right? That shouldn't happen. We should only see positive numbers or zero. There are exceptions, and that's depreciation. This is a sort of like contra asset account showing a negative amount on an existing asset, and your owner draws are subtracting what you've taken in equity. So for a little, I don't know, it's not like a fun game, but as a mini game in this presentation, I've put up a balance sheet that is riddled with errors. I want you, if you're watching here, if you're on your phone, on your computer, to take a moment and try to see if you see things that look off or incorrect. And I'm just going to give you a couple seconds while I sip my water. Okay, now here's the problems. I would be suspicious, and I see this a lot if I see multiple bank accounts listed, and sometimes I see this as like a one. This might tell me that someone disconnected an account and then reconnected the same account. And I'm even more sure there's something funny going on, is because you shouldn't have negative dollars in your savings account. So I'd want to check what happened here. Maybe these numbers should be added together and they should be merged, and it's actually 300 in your savings account. That would be an easy fix. Then I see accounts receivable that's showing a negative number. Again, we should be suspicious of negative numbers on our balance sheet. And this is what this is saying: to have a negative accounts receivable, and we'll talk about accounts receivable a little bit more, is that your accounts receivable should be telling you how much cash is out there that you need to be collecting. So the reason why Craig would have accounts receivable on his balance sheet is because he has invoiced customers, but they have not paid him. And so that's why we expect it to be positive. And if it's negative, it's almost like saying that Craig's customers have overpaid him, which shifted this number from the positive to the negative. This is unlikely that he's collected $18,000 too much from his customers, so we know something weird is going on. Same thing if we look at an asset and we see the net amount to be negative, this would tell me maybe he's accumulated too much depreciation, and really that asset has depreciated down to zero. Equipment loans, again, we expect these numbers to be positive. A negative would tell us that we've overpaid the loan by $26,000. Owner investment as negative. Again, investment should be positive. This is money put into the business, and draws should be negative. This is money taken out. And then the biggest issue here is that our assets and our liabilities and equity, they don't match. So QuickBooks wouldn't actually allow this to happen. If you pull your balance sheet on QuickBooks or another accounting software, they find a way to balance, but there's still errors hidden. There's still potential for errors hidden throughout. A big place that you'll see this in QuickBooks, for example, is in equity. There's an account that's called opening balance equity, and this is where some mess can live. So worth giving that a check. So another balance sheet health check. This is a quick lesson on calculating your debt to equity ratio. This is a score of stability for your business. And it's a simple formula. It is the total liabilities from your balance sheet divided by your total equity, also from your balance sheet. So from Craig's, we would just look back at this section and we can see those total liabilities right here and total equity right here. Now for him, we've got 41,000 divided by 44,000, give or take, and that gives us a ratio of 0.94. And we can sort of score this. If he is under 1, which is a good sign to see, it shows that basically he's built more in equity than he has borrowed or he owes. And acceptable for businesses is between 1 and 2.5. It is okay for you to owe more than what you've built, especially as a newer business. But as that grows and your debt rises and rises above what you've built, this is going to be signs of financial stress potentially, or will limit your ability to get capital. And bankers care about this because equity is that cushion. It absorbs a bad month before a lender feels it. This is less relevant if you are a brand new business. If you're in year one of operation, you probably don't have a ton going on in equity just yet, and you may or may not have outstanding loans. So take that as you will. Now, I rushed through some things on the balance sheet. Quick pause here if there are questions. I didn't talk too much about accounts receivable, so I can see something come up there.
We do have a couple questions. The first one is a multi-question question. So I'm going to read the whole thing, and then if you need me to break it down, I will. What is the best way to present these three primary financial statements to a potential lender? Is there a way to create visually engaging PDF templates that can be pulled at any moment from QuickBooks? Are all three statements usually packed in the same doc or as separate docs? Is digital the norm, or do lenders require printed copies? Thanks.
All right. Great question. We're going to break it up. So I'm going to start at the end. Digital is the norm. You should be able to send a PDF. There are certainly lenders, I'm sure, that will take a printed copy, but they're going to want to digitize it. And these days, a lot of the times you're going to be working in secure, like drop boxes where they email you a link and you log in and you upload your files. So definitely digital is the by far preference. Now with QuickBooks, the default way to get your statements is I like to bookmark my favorite ones and have the settings all set up right. And then you go into QuickBooks and you can export. And again, I'm talking about QuickBooks. There are other softwares that function similarly, but I mostly do use QuickBooks. That you go into the statement, whether it's your balance sheet, and you can download that statement for the particular date or time as either a PDF or as an Excel or CSV. So if you just want it as is, the fastest, simplest way is to go into your accounting software, download the statements as PDFs, put them in a folder, send them to your lender. That said, certain CFOs, certain bookkeepers, they might produce end of month packages that might be beautified collections of your financial statements. And I used to do this, and I used to do it manually, meaning I would go into the accounting software, download it as a CSV, upload it into Excel, do the formatting, do some summaries, add some notes. Of course, today there are softwares that do this for you, and you can connect your QuickBooks to these softwares, whether or not they are cost appropriate for a lot of small businesses. I think that's a question. But if you are working with a bookkeeping provider or an accountant CPA who handles your books, they may or may not use one of these softwares. It's going to be more affordable for them because they're going to be using it across many clients instead of just one business. And I'm sure if you are tech savvy, there are fancier ways to do this, connecting QuickBooks to other data visualization tools.
Okay. Do you have the question in front of you, or do you need me to?
Yeah. Did I answer all the pieces to it?
I think so. So, what's the best way to present these three primary financial statements to a potential lender? You talked about creating visually engaging. Are all three statements usually packaged in the same doc or as a separate doc?
Yeah, so if you're doing the fast and easy, you go into QuickBooks, you download each PDF by themselves, boom, 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 you would send them as three separate documents.
Okay.
You could merge the PDF if you wanted, or you could, I like to personally keep them in Excel because I like to calculate ratios and do little things like that. And you can add them to sheets. As long as they're all there, you're okay. The standard expectation, though, I think is single statement, one PDF. Yeah, there's always different ways.
Okay, thank you. Next question, S Corp versus LLC. Can you take owner's distribution with LLC?
So with an S corp, so an S corp frequently is an LLC. S corp is a tax election. So if you are an LLC, you can elect to be taxed as an S corp, and then you would take a distribution. The distribution is different from the draw because the distribution, it's almost like dividends. You're sharing the profits that come out that are produced by the business after you've paid yourself your regular salary. So really, in a lot of ways, the distribution in that case is still just transferring money from your business bank account if you're a sole owner. the business bank account into your personal bank account. It's just a terminology thing because you've already taken salary.
Next question. So, as a startup without any business, our balance sheet should match, correct?
Yeah, if you're a startup without any business, potentially you could see if you have spent any of your personal money on the business, that would count as owner equity investment. And the way we would see that move onto your balance sheet is um, you would, if you were to purchase something, it would end up on your profit and loss statement. And then everything on QuickBooks has two sides. So yes, it would balance. We would see there would be a cash impact on either there'd be an impact on either your cash, your equity, your liabilities, and everything always, it will always hold true. Assets equal liabilities plus equity.
We have another question. As an S corp whose founder is taking a draw, can the founder take less than the reasonable salary amount so that the business can have more financial resources to put back into the business?
I am not a CPA and I want to avoid giving too specific tax advice here. That said, this is the reason why we typically do recommend waiting to become an S corp until we know that it's financially viable for your business, because what you're risking here if you don't take reasonable salary and you're filing as an S corp is that, when you file your taxes, it can look funny and you can get audited and maybe you end up owing money. I don't want to go into too much more debt than that, or too much more depth than that. Um, so approach with caution and talk to a CPA.
That's fair. And then we have one last question right now. How would you describe the importance of a positive balance sheet, and how can this help a business owner making strategy decisions beyond acquiring lending?
Yeah. So I think, and we say positive balance sheet, I hope that means like a healthy balance sheet. And I think even if you're not going for a lender, it's still a snapshot of the health of your company, right? We still can see that equity build cushion. If you have absolutely no interest in debt, then I guess it is a little bit less important because we're not worried about leveraging debt to grow. Um, in that case, I would use it still as a reflection of, what's going on in your business. You can still catch things that look interesting or you should bring your attention to. For example, I'd say even though yes, Craig is showing some debt on his balance sheet, you could argue this is healthy debt. I would still say this is a strong balance sheet. There's nothing crazy going on. He's got solid assets. This is another sign of financial health, that you've built assets within your business. His bank balance looks good, but it's still, here's something I would check here is he's got $20,000 in accounts receivable. That's telling me even though things look good, he's in a decent cash position. His customers out there owe him $20,000. And it's a good time to look at that and question, is there something I could improve in my operations that help people pay me faster? Or am I missing something? Did I forget to follow up with that customer? And sometimes people forget, bills get lost. And we can also check how much money have I in the history of my business pulled out as owner draws. That's a helpful data point to be able to reference. So even if you don't want lending, you should look at this, is the takeaway.
Great. That's all the questions we have right now.
All right, great. So now we are on to our final statement. And I think I've recouped some time. Apologies for maybe going through things a little faster than intended. But we are onto our cash flow statement. I think this is what I find to be the most helpful statement when I'm talking and advising business owners. It's one that people don't check as much. You look at your income statement, you look at your balance sheet more. You maybe haven't played with the statement of cash flow or the cash flow statement. But it's telling us, especially if you have questions about why is my bank account lower than I think it should be every month? This is a common question. This is where you find the answers. So again, it is what a statement of cash flows. It does what the name tells us. It is showing how cash is flowing or moving in and out of your business during a time period. And what we can see here, this statement again explains why you can be profitable per your profit and loss, but you can still struggle when it comes to cash. Your cash flow statement, it's going to be organized into these three categories: operating activities, so day-to-day business operations; investing activities, that's the purchase of equipment a lot of the times, investing in assets in your business; and then financing activities. That is loans, loan payments, and includes owner draws and distributions. Now, again, the point here is that revenue is not the same thing as cash received. So we want to pull in our cash flow statement to get this full picture. Quick note again, financial statements are organized the way they are because somebody decided to organize them that way. QuickBooks, other software accounting software platforms prefer what's called the indirect methods when it comes to the cash flow statement, and it's a certain method of demonstrating the changes in cash. But there are actually other methods to present a cash flow statement, including a direct method. You may see this in different circumstances, but it is less common. So today I am focusing on the indirect method, which starts more directly by plugging in the net income line from your profit and loss, and then shows us the plus and minus cash adjustments to see net cash change for a period. So this is a screenshot of what's in the file, our statement of cash flows. And again, you can see we have our operating activities, and then we have our investing activities, then we have our financing activities. And the big important part to watch here is at the bottom, we've got our cash. This is showing the cash for the end of the period. And again, the green numbers are showing us things that are directly on our profit and loss statement. So we have that net income should match exactly the Jan to June profit and loss. So for Craig's statement, we can see here, this is his statement of cash flows for 6 months, January to June. And piece by piece, what we see in the operating activities section, we can see net cash from operations is about 29K. And this is telling us that his profit his business did generate real cash, 28,000 or 29,000 in operations, but some of this did get tied up in that accounts receivable, also known as AR. So what this is telling us is, first, this is the net income from the income statement. And then because depreciation isn't an actual cash thing that you pay out every month, it's an accounting adjustment to recognize past large asset purchases. We get to add that back to our cash. And then we have to think about the net change, the increase and decrease of what he has to collect from customers. And a negative number is telling us that we are increasing our accounts receivables. And this is saying that over that period, there's $12,000 net change in the amount of money that his customers owed him. And then we see that he also used some credit cards, and over that 6-month period, his credit card balance increased by about $1,500. So some things are going on that are affecting his cash, not directly related to operations. Or sorry, not directly related to his profit and loss statement, but they still deal with his operations. Next, we look at the investing section. In investing, all he has is he made some equipment purchases. That is investing in his business. And the impact of those purchases is negative on his cash because when you buy stuff, you use money and cash goes down. And then we have our financing activities, which this is showing where the cash went was going towards paying back the loans that he has outstanding. And also we include owner draws in financing activities. So he was able to pay himself owner draws 28,000 over this period. So all of that gets to the bottom line is that his cash fell about 15,000, even during a period where his net income was pretty solid. So it is possible for cash to fall even during a growth season. Now, again, profit does not equal cash. So we look at net income versus when we look at the change in cash, it tells two very different stories. We talked through this bit by bit on where that money went. And the lesson here is that, again, you can be profitable and still have challenges when it comes to managing your cash flows. And I think for Craig in this situation, the biggest impacts are his accounts receivables growing, which means he needs to probably get better at collections, charging his customers. And that he's made some purchases and paid off some loans. So these are fair and reasonable, but helpful to have the whole picture. When we're, again, cash flow statement like our profit and loss is best to look at over a period of time. I like to show it by month so I can see different trends and see if certain accounts are growing or shrinking. And when we look at our profit and loss over month by month, instead of over the total, we can look more closely at what's happening to accounts receivable. And we see every month it's growing, which could be a good sign that his business is like he's getting more business, which means he just naturally has more money out. But with this pattern, yeah, it tells us that this is something he should look at because it's sustained high and has gotten much higher over the period. We should look and see, you can pull other reports like your AR aging summary, which tells us how long it's been since you've invoiced these customers and what's more overdue. We're also seeing a trend in higher credit card spend, nothing too major, but just a quick thing that we might want to double check. With some pattern red flags, we are watching that the biggest thing I would watch is that the cash has dropped considerably over this period. Whereas maybe this is okay if you've got a lot of planned business in July, August, September, but as we head into slower months, we definitely want to work on building up some cash reserves. If we see equipment purchases, this is great. It's investment in the business. This is self-funded. It came from business cash itself. You didn't have to get loans to do this. But we want to make sure that as you're investing in this equipment, we're seeing corresponding revenue growth. We're also looking at the owner draws. We can see exactly how much he took month by month paying himself. And we want to make sure that he was able to increase his owner draws, but is this sustainable? Is a question we would ask. Now, another tool that you can screenshot, save, look at later with your own financial statements is this cash flow pattern quick read. This is also from Cashflow Mike. I don't want to go into all 8 for the sake of time, but we can look at Craig's operating activities. And I want to take a pause, looking at his cash flow statement. Which of these 3 would he fall into? So I want you to look, and what we need to see is which pattern by looking at first operations. Is this positive or negative? Investing, is this positive or negative? Financing, is this positive or negative? And that tells us which pattern he falls into. So skipping ahead if you didn't get there. This puts him in pattern 2, which is looked at as healthy growth, because what's happening is he is making money, increasing cash from operations. He is investing, he's buying equipment, and he is paying down debt. So it's a pretty good place to be, healthy growth. What we do want to watch out for are some of potentially other patterns that could be telling us that there's warning signs. So if I recommend taking some time trying this out on your own. All right, we are at another pause. If we have any, I don't see any questions in the chat right now.
We don't have anything right now. If you need to continue.
If the next section is pretty short, if we have cash flow statement related questions, we can also cover those. Perfect. As we move on towards the end.
Thank you.
Now, how these 3 statements connect. This is, if you take nothing else from today, I think the knowledge that your financial statements all connect, all impact one another is a key point here. So when we take our net income from our P&L, this automatically goes into our balance sheet. It feeds the equity section of the balance sheet, and then the balance sheet has our cash shown. So this has to match the ending cash shown on our statement of cash flows. Your profit and loss also has depreciation, which is going to both show on your statement of cash flow, and it also is a negative value on your balance sheet. And your cash flow statement, again, shows the changes in your balance sheet accounts. So everything does layer into each other. This is a feature, I'd say, of the spreadsheet that I've shared the link to is that you have the opportunity, if you would like, to go into this sheet and edit some of the numbers and see what happens. So um, if you have to download and make a copy, only I can make changes to this sheet because yeah, for obvious reasons, I recommend downloading and making a copy if you want to play with this like that. So we can see this at each of these, there's checks, and these checks are telling me that things are balanced, that things are working properly. If I go into my profit and loss statement and I update these numbers, this will automatically update my uh, my balance sheet here in this net income line. But now I've created this error because how did cash care, see, revenue can't go up without something else going up, and that's revenue. So in order to make this balance, I'd have to increase this account by that same amount. So it gives you the opportunity to, like I said, see where these things are connected, make adjustments. We could spend plenty of time on that, but we'll go forward. Happy to answer questions based off of that if you're spending time in the spreadsheet. Now, for Craig, telling his story, following through all of the statements as presented, what we see is from January to June, Craig's earned about $34,000, but his cash decreased by about $15,000. And this is shown in each statement, first looking at the income statement or the P&L, where we see, again, the profits generated by the business over 6 months. But the balance sheet shows us where things stand as of a particular date. We see the amount of cash in his bank accounts. We see the amount of cash that is outstanding for him to collect. We see the value of his equipment after depreciation, the total amount he owes in his liabilities, and the total amount that he has earned in his equity. The cash flow statement explains to us why cash went down despite this profit. And we can see through it that it starts with that profit number, that 34,000 in profit, and then we see where each of those changes, so that there's 12,000 tied up in receivables, that he purchased 11,000 in equipment, that he took 28,000 in owner draws, he paid down his loan principal by 4,500, and then our things are adjusted because of that non-cash depreciation, leading us to the result that while he started with 22,500 in cash, he ended with just less than 8,000 for that decrease. So income statement shows profitability, balance sheet shows the snapshot at month end, and cash flow statement explains the movement between the beginning and ending of each beginning and ending cash each month or period that we're looking at. Putting it all together, there's certain ratios that you need to leverage multiple statements to be able to identify. A big ratio that a lot of lenders care about and is something worth looking at, even if you're not looking at getting debt yourself, is the debt service coverage ratio, and this is DSCR. And so a lot of lenders have minimums that they need to see in an existing business for them to agree to lend to them. So to calculate Craig's DSCR, we use the formula, the net operating income divided by the total debt service. So we can see over the 6 months, his net operating income was 34,000. His total debt service, we take the principal that he paid, we can get that on our statement of cash flow. And the interest, that is a profit that we get that from our income statement, because technically interest paid for loans is an operating expense, while the principal paid back, that's a balance sheet account. That's decreasing an existing liability. So we need those two statements to get total debt service. And that's 6,000. And then we can use those, divide that 34 by 6, and that gives us a DSCR of 5.61, which is very high. If a lot of lenders want to see 1.25, but the caveat here that I would add is that this does not include owner's pay for Craig, because again, he pays himself through owner draws. And there's a chance that if a lender's evaluating this, they may want to adjust this for owner's draws, owner's wages, to make sure that if you are going out for debt, that you have enough money to pay back debt and also pay yourself, because that's the key part why you probably own and operate a business. Also, in this calculation does not include his credit card debt because if you're maintaining a healthy credit card balance, it shouldn't have a big impact. But if you have a large running credit card balance that you can see on a balance sheet where you're making those minimum payments every month, that might be something that a lender would want to take into account. So, this is case by case to get the full picture. But overall, if we use this 5.6 number, this is showing a strong position for conventional loans. That's a good sign of health, that he has plenty of profits generated by the business where he is able to cover debt. This is something you can check as long as you have access to these different statements and you're able to pull these numbers for your own information. And the target, again, is above 1.25. And the reason why lenders, banks care about this is because it shows the cash flow capacity of the business to continue to make payments. Your debt to equity, which is another ratio we talked about, shows really your capital structure, your debt and your equity. But this really is specifically showing us ability to repay. Again, we need multiple statements to get there. Net operating income from P&L, debt payments from cash flow statement, and that'll get us what we need. So next we are a little wrap up. Are there any questions there? I don't see any, but I'll pause for a quick water break. All right, moving on. To put this all together, I wanted to outline a potential 4-step monthly review process that you could use. So if you are, whether you're working with an accountant, a bookkeeper, or handling your books yourself, after your books are complete, in theory, the books are closed, here's where we would start. We would generate your reports. So this is as simple potentially as going into your accounting software and downloading those statements as Excel or PDF, whatever works for you. You can print them out if that's something that's going to help you digest the information. If you work with bookkeepers, they may provide these reports to you in advance. So it might just be a matter of opening up your email and pulling them up. First thing, then the next thing to do is just do a quick scan of the data quality. Does your cash balance look right? Does it match your bank account? Do the sales numbers reflect what you felt like was going on? Can you validate them? Are there any obvious errors when you look at your operating expenses? For example, if you see unexpected amounts in rent, but your rent is stable, is that something that was just categorized wrong? So just spending a little bit of time knowing what to expect and what to look for can help keep your books in good shape. And then we can do some quick health checks. Once we have them in front of us, we can calculate our debt to equity ratio. We can calculate our DSCR. We can look at the cash flow patterns. We can look generally at the patterns across our profit and loss and our statement of cash flows just to see, like, are things moving in the right direction or the direction we think? And step 4, the reason we do all of this is so we can apply tools and take action. So if we're involved in our financial statements, we're watching them, we're seeing trends, we're seeing things go well or go poorly, whatever it is. If you see it happen real time, you can make adjustments. You can say, wow, I'm swimming in profits. I'm stressed out. I need help. It's a great time to hire. Or I'm seeing that expense control rule that my gross profits are lowering even though my sales are going up. Where am I overspending and how can I make that cut to preserve profits? So that is our goal. What this looks like for Craig is after spending more time with his financial statements, he actually looks at his monthly reports. This can bring confidence that he understands what's happening in his business. He can see what's happening in accounts receivables. He can find mistakes and get things fixed up quickly. He can use the trends to spot problems. He was able to cut expenses quickly during his slow months, and he was able to discuss these ratios while applying for equipment financing. He's able to manage tight cash position proactively rather than reactively. And what this looks like for him is every month he has a time scheduled set aside for financial checkups. He first makes sure he understands what his numbers are saying. He uses the visual tools to make quick decisions. He asks better questions when talking to his bookkeeper or talking to an SBDC advisor, and he's monitoring the cash flow closely because he has an equipment-heavy business. So This is, fake Craig's statement of why he's glad he spent more time in his financial statements. My goal is that folks joining today can share similar messages and take some actions this week, next quarter, to get more involved, more familiar with your financial statements. Um, so this week you can start by identifying them, finding them. How do we access them? Do you have good access? Do these quick check. The first check is, does your balance sheet match your actual bank balance? Try your hand at calculating some ratios and take some of the charts from this presentation and maybe print them out, save them. Over the next 30 days, you can start looking at these reports monthly, even if it's just a quick check. You can complete your first monthly financial checkup. You can calculate some margins, look at some patterns, and apply rules as needed. For next quarter, looking into beyond, you can start working with your bookkeeper or any advisors to address any data quality issues or tracking these patterns over time. Use the financial analysis for major business decisions that you're considering, and then assess funding readiness if that's something that you're interested in. So wrapping up again, if you didn't grab the sheet, we've got the QR code, the link there. Got to plug upcoming webinars through Capital Pathways. These are the webinars up in line for next month. I will be back on August 13th with financial basics with some tips for just generally getting organized. So kind of the prerequisite for this conversation. So if you felt like you were already behind, definitely tune in next month. And with that, happy to address any final questions or let you all go about your day.
Kara, thank you. We don't have any other questions right now. I thank you for getting us back up and running. I appreciate all your efforts there. And I want to just thank you for your time and your excellent information. We do look forward to seeing you again in August. So for everyone, thank you for being here. Our time together has come to a close. The recording of today's sessions and slides will be shared as part of our follow-up email that will be sent to all participants. If there are any questions that arise after you hop off of here, please send us an appointment request through our website or email. We will be sure to help you or connect you to resources that can support your business needs. Thank you all very much, and we hope to see you all at future webinars. Take care, everyone.